This is by far the most important chart when it comes to investing. And the reason that it's so important is because when you embrace it, you can have more control over your investment behavior. You can start to develop real plans on what to do in certain market conditions. It will help you with buy and sell decisions. But the most important thing that it can help you do is alleviate stress. So this chart will never become unimportant because human nature has not changed and it will not change. We can boil all of our decisions down to one of two reasons: pain or pleasure. In the stock market, it's fear and it's greed. So we're going to look at the chart, and then I'm going to give you the number one tactic that you can do in order to lessen this emotional curve and grow as an investor. And so here's a look at the chart. There are a few key points, and 4 of them that I want to cover real quick. Number one, anybody that has participated in the stock market has gone through these emotions. If you've been in it long enough, you've certainly felt euphoria. I know that you've made some good decisions and you've gotten to there. And then you've also made probably some bad decisions and it's gotten down into capitulation or despondence or depression, whatever the case may be. So anybody that has participated in the stock market long enough, myself included, has gone through these emotions. Number two, one can go through these emotions in a very quick amount of time or a very long amount of time. For example, you might go through these emotions on an hourly basis if you're watching the market and making decisions on a 5-minute time frame. And on the longer term, if your decisions are more on a monthly basis, then it's going to probably take you a little bit longer to go through this cycle. But time has no bearing on it. You can go through this very quickly, or it can take, frankly, years to go through. The third thing is if you are feeling these emotions, there's a good chance that other investors are as well. So you can use that to your advantage. If you can look at the chart on the monthly time frame and you can say, oh, okay, well, you can start to outline where the emotions could be on the chart. So you can use that to your advantage. And the final point, the fourth point, the final point is this right here. It says, should I be a long-term investor? Now, there's an old joke, and the joke is that the definition of a long-term investment is a short-term one that's gone bad. There's a lot of truth in that. Now, I'm not suggesting that you be a long-term or a short-term investor at all. The point is that if you have ever bought into an investment for the purpose of a quick pop to the upside, you didn't get that pop, and in fact it went down, and then you justified holding on to it, that it's a good company, or that it's got a good PE ratio, or the book value is greater than the stock price, or they've got good management, whatever. Somehow you have justified holding on to it, then you're probably falling prey to this. So the point is that before you make any investment decision, you must have a plan in place. You must have a plan in place for every market condition and how you're going to respond to that market condition. That's the final point of should I be a long-term investor? Remember, have a plan in place. So now, here's the emotional curve. How do you lessen it? How do you sleep at night? How do you make the investment decisions easier? There is a lot of emotion in investing. And it makes sense too. I mean, there's a lot on the line. There could be retirement on the line, your cash flow on the line, a new purchase, a big purchase on the line, a dream home on the line. It just makes sense. So when it comes to these emotions, there are pretty much 2 schools of thought. Number one is that you don't have emotions. I am a robot, which to me doesn't make a lot of sense. But that is something that even this morning I heard it on the radio, somebody talking about not to have any emotions when you invest, which to me is just a fallacy. It's changing who we are as a person. I mean, we are emotional beings. And the second is to understand the emotion, know where we are, and use that to your advantage. So I don't know which one you would fall under, and I'm not saying one's better than the other. I mean, personally, obviously, I'll go with the second. Whereas, do you let the emotion come in, you feel where it is, and then you release it and move on from there? But the point, the key, so no matter which direction you go, if in fact you are trying to not have any emotion, or the second you're going to try to feel it, what you can do today in order to flatten these emotional curves is to simply invest less money in each decision. And so instead of using a large percentage of your portfolio, use a smaller percentage of the portfolio to buy in. And then what happens is over time, you're using that smaller percentage, and then you want to grow that. You want to grow that not only as your investment capital grows, but also as your confidence grows and you start to make better and better investment decisions and controlling risk better. That number will grow over time. And so the number one thing, the simplest and the best thing to do is to invest less money, and then over time grow that capital, grow that money, grow that capital, each investment decision, put more in over time. So look, I hope this was helpful. And one more thing, if you haven't gotten a copy of my book, Home Run Financial Planning, get a copy. We have more information in here about what we just talked about, the emotions of going through investing and what to do about it. So look, again, hopefully it was helpful, and we'll talk to you next time.